We have Anthony Pompliano, the Pomp podcast and Pomp newsletter extraordinaire, Melton Bemers, CSO of CoinShares, Catherine Woods, founder of ARK Investments, and Tom Jessup from Fidelity Digital Assets. Going to talk about what it's going to take to get institutions off zero, if we're there yet, and really what the investment case is and what they talk about with clients. It's a 40-minute session. It is one of the ones that I've been looking the most forward to. Without further ado, I'm going to give it away to our esteemed speakers. Thank you for joining us.
All right, everyone. Super excited about this. I feel like we are all in various locations, which is fun. Maybe we can just start round robin. My screen has Meltem at the top, so maybe go Meltem, Kathy, and then Tom. Just a kind of 1 or 2 minutes on your institution itself, and then the position that you guys currently have on Bitcoin and what you guys are doing there, just so we can level set a little bit and get everyone on the same page as to the types of institutions we're talking about here. So Meltem, maybe start with you.
Sure. And it's great to be here. I've known Kathy since 2015 when I was at DCG, and ARK was the first investor to add Bitcoin exposure to publicly listed ETFs. So it's great to be reunited with Kathy. I think she was the first person I talked to back in 2015 who was really excited about providing Bitcoin exposure to investors of all types. And then great to be here with Tom as well, who I've known from his Goldman days, his time at Chain. And it's great to see so many great faces who are really helping to bring Bitcoin to a wider audience of investors. So my name is Meltem. I work at a firm called CoinShares, and CoinShares is a firm that provides digital asset products and services to investors of all types. We're probably best known for our family of investment products, which trades in the European market under the XBT provider brand Pardon. We have about 700 million in assets under management across our exchange traded products, primarily our Bitcoin tracker and our Ethereum tracker. And really our goal there, what we've been doing for the last 5 years with those products, is making it really easy for anyone with a brokerage account in Europe to point, click, and buy Bitcoin exposure or Ether exposure and add it to their portfolio in a tax advantaged way. We've tried to do that in the US as well, but as I'm sure we'll talk about here, it's been a bit more challenging just given the approach from the SEC. And then in addition to that, I manage our active funds business. We have a venture fund, and we're looking at a variety of active beta delta neutral funds. And then we also have a large trading business. We traded 1.5 billion in notional last quarter, both on our props or balance sheet, as well as helping our clients, which are typically trading firms who tend to do a lot of on-screen execution. So we have a wide range of services. We just launched a new index product last week that combines Bitcoin and gold. So lots to talk about, but I'll hand it on to Kathy.
Okay, thank you, Meltem, for that nice welcome, and you too, Pomp. And good to meet you, Tom. So ARK Invest, as Melton mentioned, was the first public asset manager to gain exposure to Bitcoin through GBTC in September of 2015, when Bitcoin was $250. And we put it into 3 of our ETFs and let it run all the way to 20,000. As it was running, it began to fork, and we learned about something called unqualified income, and how the IRS felt about unqualified income. Not illegal, but unqualified, meaning it was more of a commodity exposure within an equity portfolio. And we learned quickly that, if there were a black swan event where Bitcoin increased as the stock market was declining rapidly, basically anything over 10% of gross profits would go to the IRS, not to our clients. So we had to pivot, and we did. Right now, Bitcoin in our discretionary separately managed accounts, again, through GBTC for the moment, is about 5 to 6% of those portfolios. And we are launching a private fund. It is going to be limited to cryptocurrencies. And we think there will only be 3 or 4 cryptocurrencies over the long run. So limited relative to the number of crypto assets out there. But we do believe that the value accrual in this space will go primarily to cryptocurrencies. So it's quite deliberate from our point of view. So ARK Invest is, we manage now $15 billion. Our focus is exclusively on disruptive innovation. We're always happy to take a challenge like Goldman handed to us last week. We're about to put out a response to that. And we are also about to update a paper that we first put out, a white paper in 2016 called Bitcoin Ringing the Bell for a New Asset Class. We're going to update that along with Coin Metrics. So it's going to be fun. It's going to be a lot of fun. I really feel like the debate is going to help us all become better at understanding, how quickly this will become an institutional asset class.
Guess it's my turn. Kathy and Pom, great to meet you. And Melton, is always wonderful to see you. So I'm Tom Jessup, everyone, and I'm responsible for the digital assets business at Fidelity. I think most of you probably know the story about Fidelity. Between our employee benefits business and our personal investing business, we interact with about 1 in 3 US households. We also have a pretty large institutional business. We have a traditional prime brokerage business dealing in other asset classes. We also serve as a custodian to a large number of RIAs and family offices and other traditional investors. Our business was born out of some research that our CEO, Abby Johnson, started as far back as 2015, trying to understand the implications of this new asset class for finance, and the new technology is perhaps a force enabler for the traditional businesses we're in. We've been doing things like running nodes of various networks for that period of time. We still mine Bitcoin. And what sort of bubbled out of this primordial soup was our digital assets business, which we announced in, losing track of time here, late 18, went live in 19. We got our New York State Trust license in November. And we provide a set of custodial and trading services, i.e. prime services, to traditional institutions, like many of perhaps the other well-known competitors in the space. We do think and we do see that this is becoming a more mainstream asset class. Some of you know that last year we did a survey of several hundred institutions globally. We reported on that. I'm happy to say we've reprised that survey with a larger number of investors, and we'll be publishing those results in the next couple of weeks. And so we are starting to see this continued steady move up and to the right in terms of institutional interest. And I think it augurs well for certainly everyone on this call, but also the entire ecosystem. So we're happy to be playing a role in helping drive that forward.
Awesome. It would be an understatement to say that we've got 3 experts with us. So glad you guys are all here. Maybe we can go back to you, Melton, and you can help us understand what you guys have seen. You guys have your hands in various parts of crypto, from asset management to actually trading, et cetera. And over the last 10 weeks or so, there's been incredible volatility in every asset class for the most part, right? So we've got the pandemic, the government shutdown, and now we're seeing a lot of social unrest here in the United States and also elsewhere. Maybe talk a little bit about what you've seen change in the crypto market over that period of time. And then Kathy and Tom, we can come to you guys and talk about some of the larger asset managers and how that's changing the conversation, both internally and with customers.
Sure. And I think that's a great setup, Pomp, in really framing the discussion. I think as we were prepping for this panel, one of the conversations we were having is, when we look at the investing landscape, the way that risk has been priced and evaluated has changed in the last 2 months, right? Assets that we thought were not risky, all of a sudden it turns out were risky. If we look at what happened with the oil ETFs, right? The fact that oil futures could go negative, that's something we had never seen before. What happened, leading up to March 26th. These are sort of unprecedented events, at least for this generation of investors. And so when we just think about the way our conversations with investors would go, even as far back as 5 years ago, when we actually did a launch event for the ETF with Kathy at our DCG offices way back in the day, the commentary from investors was always, look, Bitcoin's way too volatile and it's way too risky. And if we look at the Goldman commentary on Bitcoin that came from the sort of high net worth facing, wealth management facing part of their firm, we get a lot of the same commentary, right? It's highly speculative, it's highly volatile. I think one of the things that's really been put into context in the last few months is that volatility is highly relative, and every asset class is volatile right now. And if we look at what's happened with Bitcoin, right? Obviously, Black Thursday, the big crash that happened, the correction following events across a number of different exchange platforms. Yes, there was sudden drop in the price of Bitcoin. Part of that I think was driven by market forces, and market microstructure, which is an area we invest in heavily, given that we have electronic trading systems and the options and futures part of this market is just beginning to develop. But if we look at sort of activity on the Bitcoin network, a lot of people have been accumulating for a long time. If we look at the number of people who are holding Bitcoin and have been holding it for over, the last 2 or 3 years, that number continues to go up and to the right. And if we look at just the behavior of people who hold our certificates, there are about 40,000 clients who hold our ETPs. A lot of them have held them for a long time and continue to hold them and are not willing to sell them at any price, which I think is a really interesting indicator. So what we've seen is that the volatility objection that a lot of investors had to Bitcoin has gone away. And then the second piece is, as we look at the landscape of investment opportunities, we're generally seeing investors moving further out on the risk spectrum to get reward. And this panel, the conversation is get institutions off zero. What are you going to invest in when the price of risk has changed dramatically? There is no longer the ability, to get 1.5, 2% from a low risk bond fund. That just doesn't exist anymore. Money market funds, you're not getting a return. So people need to invest. Fiduciaries are responsible for meeting their investment mandates and generating yield. And so as investors look at the landscape, I think there are two areas where there are a lot of opportunities. One is in private markets, so PE, but really importantly, venture capital. The amount of capital allocated to venture continues to go up, and crypto, for a large part, has been put into this venture bucket, and hopefully that starts to change. And then the second area where we're seeing a lot of interest is alternatives. And I think for some people now, crypto may fall into the alternatives bucket. And I think that's a perfect sort of segue to Kathy, as we look at the argument of fundamental value versus growth. Kathy, you've been investing in growth. I follow the ARC research extensively, and I think you've been right on a number of calls when it comes to growth industries. But I think investors are now more open-minded, perhaps, because in order to meet their objectives, they're going to need to change their mindset. And it's brutally painful, and it's going to take a long time. Like, no one's convening their IC right now to make broad sweeping changes to their investment mandate. But I think in the months and years ahead, as institutions in particular look at the challenges of underfunded pensions, higher education looks at, needing to tap into their funds in order to meet some of their liabilities and keep researchers on staff and institutions running, there's a big challenge. And I think crypto assets are going to have to be part of the solution. But Kathy, maybe I'll hand it off to you to expand on that.
Sure. Pom, is that where you'd like us to go? Just kind of hand it off to one another?
Yeah, I mean, look, at the end of the day, this is your guys' panel. I'm just here to play referee.
Okay. So yeah, it's been very interesting to try and elicit institutional interest in Bitcoin. We think, especially after the coronavirus, and now we've got in the U.S. we're slated for $9 trillion in reserves out there by the end of this year. I believe that's the number. So double what it was at the end of the 08-09 crisis. And, I think a lot of people are saying, well, I don't have to worry about inflation. I was worrying about it after 08-09 when I saw this happen. And, it didn't happen. And the reason inflation did not happen is because velocity slowed down. It not just slowed down, it started falling, and it's still falling. And all that means is the rate at which money turns over in the economy was falling. So people wanted to hold cash. They wanted to hold dollars. I always look for sort of the consensus point of view and say, okay, where could that be wrong? Now that many people are not worried about inflation, I'm going to worry about it more. Not in the short term, because I do believe we are going to see one heck of a productivity increase coming out of this crisis. And we've seen what's happened to oil prices as well. So, a lot of people are going to probably not worry about inflation for quite a while. Certainly that's what the bond market is telling us. But I am beginning to worry about it 3 to 4 years out. And I want an insurance policy. And I do believe that going to institutions with that idea in mind is going to be more impactful over time. So we're not seeing the acceptance we actually thought we had seed for our private fund from a state pension plan. And we're already running money for them. And when they heard that we would be, and we already own GBTC for them, when they heard that we would be breaking it out into a separate fund and that it wouldn't be part of their existing fund with us, that was just too much visibility. It was too much that they felt a sign to their constituents that they themselves were a believer that Bitcoin was an important place to invest right now. They did not want to be that exposed. They want to keep it now, even though it would have been much more economical for them to have seeded our fund than to pay the 2% per year on top of our fees. They decided to stick with the old way of doing things until there is more institutional acceptance. I think Goldman set us back a bit. I think Paul Tudor Jones a few weeks ago set us up a bit. We're going to have this back and forth. I think Fidelity's been huge, of course. Cambridge's report about a year ago saying, hey, you should at least consider this as an alternative, has also been important. And of course, backed and CME with Bitcoin futures. So I think the bones are being put in place for this. The skeleton for this is being put in place. I think that another thing that happened recently, of course, the coronavirus and the drop down to 3,500, we learned, I didn't know this. Now, Yassine El-Mandra, who's our amazing analyst, handpicked by, must say, by Chris Berniski, he, of course, knew the kind of leverage that was out there in BitMEX. It was kind of, I suppose, common knowledge. And the people who were taking on this kind of leverage seemed superhuman, where they were the masters of the universe all over again. And now they're not. I think that's actually a really good thing that happened, that, this 100 times leverage on anything is a big red flag. And do we know what we're doing? And what kind of infrastructure do we have and governance do we have to prevent that kind of behavior? I think that's a good thing that it happened, that it was exposed, that it happened to expose to those of us who understand what leverage means and how badly it can go wrong. So I think it's been good for the ecosystem. The bones are coming into place. These are growing pains. And we have not lost one bit of confidence that this is going to be a huge asset class.
Maybe I'll just jump in quickly to amplify both what Kathy and Meltem said. So I think from a macro standpoint, I agree with Kathy. I think that our perception, I'm sure others have seen the same behavior in their own businesses, is that given COVID and this unprecedented monetary stimulus, anyone who sort of had a hard money thesis around Bitcoin and was thinking about implementation, I think has sort of gotten off the fence and is now doing that. And that is, for me, a sign in the general progression of the investor mindset, where you first have to understand the asset, you have to diligence it, you have to understand its role in your own strategy, and then you start thinking about how you operationalize that, whether it's through custody or trading, or even how you want to express the view in terms of direct ownership, or perhaps through some sort of fund structure. So I think we saw a lot of those institutions that had sort of gotten to the thesis space decide this is the catalyst for me now to move into the market. I think what we're also seeing, and maybe back to Meltem's point, is that for more traditional investors who have underfunded liabilities, they're operating in a low return environment, I think what it's done, it's probably accelerated the thesis development part of their analysis, and they will be at the point of thinking through the operational implications. But the way that manifests itself to us and again others are, more traditional investors, more interest from pensions, endowments, more interest in education, because they still have to come up with the, what is the role of this asset in my portfolio before they get to the how do I express that. And that's something we're seeing. I'm sure all of you are seeing that as well directly, but we're also seeing it in some of the research results we've been getting. And maybe to put a fine point on this, I know, for years, everyone said, 18 is the year of institutional crypto, 19 is the year, 20 is the year. I think for those of us that come from a traditional finance background, this is a reasonably long time frame. It's more of a tide than a wave. I was trying to think of a historical analog. And the ETFs, you can't, ETFs are the call it the vehicle du jour for a large number of retail and professional investors. Most people forget that the first ETF was launched 27 years ago. I mean, and I'm not suggesting for a minute, because the pace of change increases with every successive innovation. But it's going to take a lot of hard work, but the environment is now there. And so, we feel very positive, both in terms of what's happening from a macro standpoint, but also the positive effects of these assets on a traditional portfolio, that we'll begin to see more of this movement, this wave, or this tide.
Awesome.
I think.
Go ahead, Kathy.
Yeah, I was just going to say, Tom, so do you do believe that an ETF, like Mr. Pierce is right, and that an ETF is likely with Bitcoin, or did I misinterpret you?
No, I'm talking more just about the rate of institutional adoption of new products. So whether it's ETFs, whether it's credit derivatives, interest rate swaps, these folks, I mean, Kathy, you can speak to this. I mean, just given the responsibilities you have as a fiduciary, and, it just takes a long time to get from thesis development and understanding the assets to operationalizing them. What I'm saying is that historically, that's taken not months or short years, it's taken longer. I think now what we're starting to see is you both have the macro overlay, which is interesting for this asset class, as well as an acceleration of understanding around what does the asset class do in a diversified portfolio.
Yeah.
And so I don't think it's going to take as long, and I have no perspective on a Bitcoin ETF, but I do think we have to think about adoption more from a traditional institutional analog of traditional products that have been adopted, by a wide number of investors, versus perhaps what we may want to happen as enthusiasts in our industry.
Yeah, I actually have, because I've been around the track a number of times for a very long time here. I started in the business, and I remember at a Capital Group I was in college, but in the late 70s. And I remember they were trying to figure out, why can't we get this mutual fund business going? And I mean, it was dribs and drabs. This was the late 70s. And then, of course, it mushroomed into, what is it, a 10, 12 trillion dollar. It's much more than that. You would probably know the numbers. And now we have the ETFs. When did that take off? So mutual funds really started taking off when individuals, the baby boomers, in the early 80s, were trying to figure out, how to invest. And this was a new vehicle, and a bull market started. So the demarcation point was interest rates, inflation started coming down in the early 80s. And everyone was looking for, how to play this bull market. It had been a long time coming. ETFs took off after two crises. So tech and telecom bust was first, and then 0809 meltdown. And they took off at an accelerated rate then. Active management, off with your head, and passive management is the way to go here. And I think this coronavirus and all of the lessons that we're learning here, and as Meltem said, no yield anywhere, is a rallying cry for a new asset class, and especially one that is, I'm going to say, just Bitcoin itself. The whole idea of mathematically metered, compared to what we're seeing now in monetary policy. there has to be a role for this, even if you don't understand it that well, but you believe. We just went through a halving. That was a big change right there. I think from an institutional point of view, there have been institutions waiting around saying, okay, let's see what happens then. Could there be forks again? And are we going to be on a whole new set of controversies? It didn't happen. It was very methodical, and so I actually think we're probably on our way.
So one of the things I want to spend some time on is between all of us here, I think that there's probably $1 billion plus, maybe $2 billion plus worth of assets that have come from sophisticated investors. Some of those are institutional in the sense of endowments, foundations, and kind of what we would consider those types of institutions. Some have come from more of the Wall Street type firms. We've talked about the macro backdrop, basically pushing people to learn more about this. There's a body of work that needs to be done. Just what is it? How does it work? How should I think about it? Allocation wise in my portfolio, all of those things. But then that leads to the question of how do I actually get exposure? And most of these institutions have very unique challenges. One is they're not going to write, $100,000 check. So they're coming in size. Two is they have a lot of regulatory or risk management type guidelines that they need to follow. So qualified custodianship and things like that. And then three is what I'll just call kind of cover your ass, right? If you go ahead and do this and it doesn't go well, there has to be certain safety nets in place, whether that is just qualitatively being able to say, well, Paul Tudor Jones and Fidelity and everyone else did it, or other things that can get you out of a trade or something like that if all of a sudden there are issues. Can we maybe go just around the horn real quick and talk about the various ways that we're seeing institutions actually get that exposure? Because I think one of the misconceptions in the retail space is that some public pension is going to go on Coinbase and just let a market order run. And obviously that's not going to happen. So Melton, go ahead.
I can kick it off. So look, I can break it down very simply, right? There's a number of different strategies that people can use, and they have different risk profiles. So at the highest risk end of the spectrum is selecting the assets yourself, building internal competence to custody them, to execute your orders, to structure a strategy, to custody your own assets, to do your own post-trade reconciliation, accounting, everything. And very few firms right now are ready to do that. There are a few, and I think what Fidelity's built with digital assets is a great example of a firm that said, hey, we're going to invest heavily in building this competence internally, but it's a lot of work. So there's that strategy where people are actually owning the assets themselves. There's a strategy that Rentech, which I think actually the Rentech announcement to me is bigger than Paul Tudor Jones, because Rentech is such a phenomenal investment firm and they deliver results like nobody on the street. I mean, they can charge 4 and 40, that speaks for itself. So Rentech getting exposure to Bitcoin through the CME futures, which are cash settled, I think has been really interesting. And just looking at the tremendous growth in the cash settled futures and options market, the incredible growth in the derivative space and the ways people are getting exposure is really important. And I think that's more important for the part of the market that we serve with our trading desk, which is people who are looking for full electronic integration. They're looking for execution capabilities across multiple venues. They're deploying statistical arbitrage strategies. These are really the firms that led the way in commodities. And these are also going to be the firms, I think, that lead the way in digital assets and building a lot of that market structure to connect the Wall Street plumbing to the crypto industry plumbing and starting to develop some of these standards like ISDA, an ISDA equivalent for options, on-chain calculation agents and how that might work. And this is a lot of what we're working on and investing in and trying to work with different industry partners on. Then as you start to get into managed allocation strategies, you have passive vehicles like ETPs, which we have. You have the GBTC product, which is passive. But again, you're looking at, GBTC, the fees are 2.5% plus 2% expenses. So you're looking at 4.5% a year. It's really expensive. Then you look at venture funds and hedge funds. There are now a wider range of funds. And I think there are a number of places where you can track them. Hedge Fund Review, HFR, has a great tracker. Internal to the industry, there's Vision Hill, which sort of tracks different funds. But you're paying 2 and 20, in some instances 3 and 30, and you're not getting pure Bitcoin exposure. You're getting Bitcoin and a bunch of other stuff. And I think this idea of industry diversification by owning a basket of crypto assets is still a little early for that because the beta of most digital assets is 1 to Bitcoin. Everything sort of moves together. And then lastly, you have people looking at fund-of-fund strategies where you're paying 2 and 20 and 10 on top of that, which is, again, I think just really expensive and it's difficult to defend. And so I think there's a wide range of options. You have people direct investing as well. So I think if you look at, Tiger Global, one of the largest PE firms in the world, investing in Coinbase's Series D, that's a great example of people buying private market exposure via late stage crypto unicorns. And there are now a number of them out there. I think at last count, there are about 20 different crypto unicorns that people could get exposure to in larger size. But 20 million is still a relatively small ticket. And then lastly, there's public equity. So you have NVIDIA, which I think is an interesting public market proxy. It's a chip fab. You have Canaan Mining, obviously, as well. And then there's Hut 8 and Bit Facilities, the mining company in Canada. You have Galaxy. So these public market, I think, sort of proxies that people are using to get exposure. But I think, again, that universe needs to continue to expand as we look at some of these unique mandates. But I'm of the mindset that, having a little bit of exposure via venture fund with a 2 and 20 structure doesn't really make sense if you want to be fundamentally long Bitcoin. So I'm of the mindset that the same way that, commodities really were formalized through the creation of the Goldman Sachs Commodities Index, the GSCI, and a number of hedge funds that were started to invest in commodities. I'm thinking a similar thing will happen in this space where it'll really start with the trading side and the development of more sophisticated trading instruments, hedging instruments that allow for risk management, risk mitigation, different types of exposure. And then that will sort of pave the way for the rest of the institutions to get comfortable. So I'm very excited about developments there. Last year, we did $3 trillion in options trading in the industry. This year, I think we're on track to treble or quadruple that if what we've seen in the first half of the year is any indication. So I'm really excited about what's happening on the market formalization side. And I think that'll really give people more options when it comes to exposure.
So would you like me to follow on there, Pomp? Thank you. So I think Melton covered the landscape beautifully. I working with Yassine, just trying to get at, okay, what are we talking about per day here in terms of trading? And what he's done is he's done an amalgamation of exchanges. This is very conservative. It obviously is not 100% right because some of these numbers are difficult to get. But if you look at BTC and fiat in dollars, we're talking about $500 million to $1 billion per day. If you look at if you look at all stable coins measured in BTC, it works out to roughly 3 billion per day. If you're looking at derivatives, a big part of this BitMEX, 14 billion per day. In terms of the institutional world, these are very small numbers, very, very small. And so I do, and in the context of, US dollar trading per day, 5 trillion. So, that's what we're talking about here. We're in the nascent stages here. I agree with Melton also that we're seeing in the equity markets, we can get exposures on NVIDIA. I would say that was the story. Now that everything's going ASICs, really Taiwan Semiconductors probably the player, and it's interesting to hear institutions talk more and more about Bitcoin when they own something like Square, which enables the trading of Bitcoin. So they have to start thinking about it, which is great. I also think that something akin to what happened to the evolution of emerging markets investing could happen here. Now, MSCI, they effectively created that. I won't call it an asset class. It's equities is the asset class, but this construct of an emerging markets exposure. And they did that. And I remember I was at Capital, but Capital was very early into investing in emerging markets. And it was Brazil, Malaysia, one by one. And then here comes MSCI, and they say, wait a minute, what you're really trying to do here is develop this exposure with enough diversification inside of it that you're lowering the risk of, instead of this onesie twosies. So I think something like that could happen. It can't happen in an ETF construct because we have, is this a security or not? You've got the SEC versus the CFTC. So, we need to maybe have some more, we definitely need to have more regulatory clarity. But I think once we do, that would be a very interesting way for institutions to gain exposure.
I would just add, because I know we're running short on time, that in terms of the clients we speak to, I think a couple of trends. So I think that clients are more comfortable owning directly. So if given the choice between investing in a single asset product with fees attached versus owning directly, subject to their own legal and regulatory and other analysis, they're more comfortable with that. Where they tend to show interest over the longer term are around index products, so getting exposure to a basket of digital assets. So not making a foundational bet on one versus the other. And believe it or not, there's also some interest in active management. And I think the thesis there would be there are people who understand the space and can probably generate alpha within the crypto domain better than they could selecting assets directly. And I think, maybe to just tie that back to what Kathy said, I think that the only way all of these things scale, particularly around active, is if we increase the trading capacity of the market. It's incredibly small. Clients still have concerns about market manipulation, whether truthful or rumor. And these are things we have to sort out, because the amount of trading that goes on in this market will not support certainly any form of active management at scale.
Yeah.
Makes a ton of sense. I want to end. We've got about 2 minutes, so maybe just one or two sentences from each of you on 10 years from now. What does Bitcoin and crypto look like in the institutional world? Tom, we'll start with you. By the way, you've got a great haircut going. I've got a hat on because I can't find a place to get a haircut. So we're going to talk later about what.
I've got a haircut since January, so I'm doing my best to keep it down. So in 10 years, look, I think in 10 years, it will be a mainstream asset class. I think that, there's a chicken in every pot. I think every large investor will have some allocation. I think the benefits in the context of a broader asset portfolio will have been proven. You've seen some great research recently by folks doing this work. And so I think it will be, I don't want to call it digital gold because it's so much better than that, but it will be a mainstream asset. That's my firm belief. Awesome. Kathy?
Yeah, I'll echo that, of course. If Bitcoin were just to take 10% of the gold market, we're talking about a $45,000 price. I think that's easy, and that's just one use case. I mean, the idea of, ensuring against the confiscation of wealth, whether that is through inflation or actual outright confiscation, which we're seeing in more and more emerging markets, and not even some emerging markets. I think that it's going to be scary.
Are we getting told to shut up?
Time's up.
It's like the Oscars, man.
That's fine.
Wait, Selkus, where's the trebling song? Do you want me to sing my prediction?
Go ahead, Meltem.
All right. Bitcoin trading volume gonna treble or quadruple this year. I think I'm less concerned about the price. I'm more concerned with getting crypto out of centralized custodians and making sure that there's a robust, free, open software development ecosystem, that we're contributing to open source code, and that we're continuing to build tools, not just for the institutions, what I call the evolution, and bringing Wall Street into crypto, but also for the revolution. This is a money revolution. And so a big part of what I'm excited about, not as a fiduciary necessarily, but as a human and a person in context of what's happening in our country today and across the world today. We need to give people tools, the same way that the internet made information free and accessible and communication free and accessible to everyone on the planet. I'm really excited for Bitcoin to do that for money, and I'm going to do my damn best to make sure that happens, whether that's wearing my CoinShares hat or my hat is Meltem. So let's get some leaders up in Washington who can help us make sure we keep Bitcoin open and free for everyone.